question of November 2020. We want to continue from there, November 2020. Question number 5. Question number 5B. November 2020, question number 5B. I believe you are opening so that we go straight to that. I can see Edwin joining. Welcome, Edwin. I can see you joining. Okay, we were looking at the question of November 2020. This question said, on 1st January 2019, Camille Limited commenced a defined benefit pension plan. Just a minute. Can continue now. Okay, sorry, but we continue now. We continue. Oh, this question says, on 1st January 2019, Camille Limited commenced a defined benefit pension plan for its employees under the pensions plan. Camille Limited has an obligation to provide staff with agreed post-employment benefits. Camille Limited carries the actuarial and investment risk associated with the pension scheme. The following information has been compiled for the financial year ended at 1st December 2019. We have interest income on plan assets, employer contribution to plan, current service cost, interest on plan liability, fair value on plan assets, present value on plan obligation. Camille Limited's accountant was not sure which accounting standard to apply when accounting for the pension scheme. The only adjustment made to account for the scheme was to expense the company's contribution of 55 million for the financial year ended at 1st December 2019 in the statement of profit or loss and other comprehensive income, and to credit the cash required. Evaluate their treatment. Camille Limited's accountant has given the above issues and offer the correction if and where necessary use journal entries, 10 marks. Now, in this regard, examiner wanted you to correct where necessary, where we have journal entries we did yesterday, like for example, on the contribution to the DB scheme, you debit what we call, you debit plan assets, then you credit cash. But what he did, he debited P&L, which was a great mistake. So it was a very big mistake. Therefore, we need to debit plan asset, we credit the cash. Then we also did other journal entries. Therefore, today I want us to go to account for this scheme. Let's account for this scheme. And yesterday I did give you the steps to be followed when you are to account for a scheme like this. First, I said step number 1, you are going to prepare actual gain or loss on plan assets and plan obligation. Number 2, you prepare what goes to the income statement as pension cost. Then number 3, you prepare what goes to the balance sheet as plan liability. Therefore, here we are going to step number 1. Step 1, we say actual gain or loss on plan obligation, actuarial gain or loss on plan obligation, actuarial gain or loss on plan obligation. Here we are in year 2019. We are in year 2019 there. And remember, this scheme was started on 1st January 2019. Therefore, our present value of plan obligation at start is 0. Why is it 0? Because this is a new scheme. We are beginning the scheme on 1st January 2019, and the examiner wants the financial statement at the end of that 1st December 2019. Therefore, it means when we opened, the opening obligation was 0. There was nothing when we started. Then, what will increase the obligation? We say current service cost. Current service cost. Current service cost, which is 600. Then past service cost. Past service cost is not there because this is a new scheme. We have not done any amendment. We have not done any amendment. There is no past service cost because this is a new scheme. This is a new scheme that has just started. There we remember we said that what is past service cost? These are the payables to the employees for the services rendered in the past year, or the amendment made the scheme to give employees more comprehensive benefits. Therefore, there has not been no amendment, as you can see. Then interest cost, interest cost, examiner has given us 18,000. That is the interest cost. Then we less benefits paid, less benefits. Benefits paid is a dash because this is a new scheme. We cannot just start the scheme, then we start paying benefits to employees. Therefore, there is nothing. Therefore, my projected book value. Projected book value is 618,000. 618,000. That's our projected book value. But when you check in the analysis, examiner has given us the present value of plan obligation that 1st December 2019. Therefore, we skip one line and say present value of plan obligation at the end is 620. That is what we have at the end, but the projection was 618. Therefore, the difference, we are going to call it actuarial gain or loss. It is actuarial loss or the measurement loss of 2,000. It's a loss because we projected 618. At the end, we have 620. It's a actuarial loss. It's actuarial loss of 620 of that amount, actuarial loss. That is how to prepare actual gain or loss on plan obligation. Then quickly we go to number B. Number B, actual gain or loss on plan assets. Here, we are also going to begin with actual gain. We are in year 2019. We go to actuarial gain or loss. Sorry, fair value. We start with the fair value of land assets at the start of the year. Fair value of land assets. At the beginning of the year, it is 0 because this is the year we have just started. Therefore, it is 0. But if it's a continuing scheme, then of course we shall have the balance. Remember, this is just like any business. When you are beginning a business, of course, the balance brought down is 0. But as you continue, when you end the year, when you open another year, of course, there will be a balance. Therefore, here fair value. Then what will increase our assets? Contributions. Contributions to the scheme of 550. What else will increase the assets? Expected return or interest income. We have interest income, or what we are saying expected return of 16,500. 16,500. Then we need to pay out the benefits, but we are not going to pay out the benefits because this is a new scheme. This is a new scheme, therefore I go to less. I go to less benefits paid. In normal circumstances, it is a continuing scheme. We less the benefits paid. But this is a new scheme, is when we have started, therefore we have none. Then we get the projected book value. Projected book value is coming to, that is 565, 66, is it 566? 566, 500. That is our projected 566, 500. We are just adding. Then we say fair value of plan asset at the end of plan assets. At the end, we are given 580. The end is that 1st December, we are given 580. Therefore, the difference is actual gain or loss. It is actual gain of how much? Actual gain of how much? Actual gain of how much? 13,500. Thank you very much, Ruth. 13,500. That is the actual gain. Actual gain. Therefore, those actual gains are required to be recognized as other comprehensive incomes. You recognize them as other comprehensive incomes. Those actual gains and losses, you are required to recognize them as other comprehensive income. Therefore, we prepare a statement of other comprehensive incomes. Statement of other comprehensive incomes. Statement of other comprehensive incomes. We prepare a statement of other comprehensive incomes. Year 2019. Year 2019. We say actual gain on plan asset, which is 13,500. Actual gain on plan asset. Actual gain on plan asset. Actual gain on plan asset. Then I come to less. Actual loss on plan obligation. On plan obligation, which is 2,000. Therefore, my comprehensive income, that is the OCI, will take 11,500. My OCI is going to take 11. That is statement of other comprehensive income. Then we go to pension expense, profit or loss statement, profit or loss, extract. What are we going to take to profit or loss? Extract there. We are going to take, we are in year 2019, don't forget. What are you going to take to our financial statement as pension cost? You take the current service cost. Current service cost. We say the current service cost, in this case, it is 600. thousand. Then you add past service cost. In this case, we don't have past service cost. Interest expense. Interest expense is 18. Then we less interest income. Interest income is 16,500. Then there's nothing, therefore we get pension cost. What goes to pension cost as an expense to P&L as pension cost there? You just get it like that. Then we prepare balance sheet. We go to balance sheet extract. Balance sheet extract. I believe you have this figure. Don't expect it from Marimu. I believe you have it. You are doing it. I don't ask Marimu, how much was it? It is you who has the calculator, therefore quickly you do it. Then we go to balance sheet extract. What goes to the balance sheet? That is balance sheet. Balance sheet extract. What goes to the balance sheet as plan, liability, or asset? We are still in year 2019. Therefore, I take present value of plan, liability. At the end of the year, which is 620, I come to less fair value of plan assets at the end, which is 580. When you less, we are getting plan liability or pension liability of 40,000. Of 40,000, pension liability of 40,000. That is what the examiner wanted, plus the journal entries, then you get your marks there, then you get your marks. That is what the examiner wanted for you to get those 40 marks, 10 marks. Let's look at another question. If you are okay with this, if you have any question, just put it in the chat. Let's look at another question. That is the question of May 2019, question number, I believe 3A or 3B. Wasiri, you say? Please show me the board. How will I show you the board now? How will I show you the board? Okay, let's go to May 2018, May 2019, question number 1. Question number 3, sorry. May 2019. May 2019. A question of May 2019. Quickly, I believe you are opening quickly. May 2019, I believe you are moving there faster. Radim is already there. If you have the question so that we continue together. This question says like this, number 3A. 3A says like this. With reference to International Accounting Standard IAS 19 employee benefits, briefly explain the accounting treatment of the defined benefit pension surplus, that is planned asset in the financial statement of an employer. Briefly explain the accounting treatment of planned assets in the statement, in the financial statement of the employer. Briefly explain the treatment of planned surplus. Now, when they talk of planned surplus, this is what the examiner means. For example, when you are preparing balance sheet, your balance sheet. When you are preparing your balance sheet, we have a present value of plan obligation at the end, 620. Then fair value of plan assets. I'm just using the previous question we did, 580. Therefore, we have the difference of 40, that's a liability. Now, what the examiner is saying, suppose it's a surplus, suppose it's an asset, how do we account for it? For example, it's the reverse. This is 580, this is 620, this is 620. Suppose it's the reverse like this. How do we account for this in the financial statement of the employer? Remember yesterday we did mention something on asset ceiling. We mentioned something on asset ceiling. Therefore, that is what the examiner is asking. Asset ceiling. If you are there yesterday, we discussed something very serious on asset ceiling. Therefore, we are going to measure it at asset ceiling, where we look at the exact amount as calculated or the present value of future economic benefits that will be available for refunds or reduction in future contribution. That is how we are going to measure it at that time. That's how we are going to measure that item. That's how we are going to measure it. That is what the examiner wanted for 4 marks. We are going to measure it at asset ceiling. Then number 2, it says, W Limited, a public limited company, operates a defined benefit pension plan for its employees. The present value of the future benefit obligation as at 1st January 2018 was 38 million, and the fair value of the plan assets as at the same date was 60 million. The further information relating to the pension plan for the year ended at 1st December 2018 was as follows. We have a current service cost, benefits paid to former employees, contribution paid to the plan, present value of benefit obligation as at that 1st December 2018, fair value of plan assets as at that 1st December 2018. Additional information. Interest cost gross yield on blue chip companies or corporate bonds is at 5%. On 1st January 2018, the pension plan was amended to provide enhanced benefits with effect from that date. The present value of the enhanced benefits as at 1st January 2018 was calculated by actuaries at shillings 110 million. Required. The required notes to the statement of comprehensive income and statement of financial position to reflect the financial effect of the defined benefit pension plan in the year ended at 1st December 2018. 8 marks for free. Examiner was wishing us success in this question. Now, ukiangalia in note number 1, examiner has given us the interest cost gross yield on blue chip corporate bonds is at 5%. Therefore, listen very carefully here. If I want to determine my interest cost on plan liabilities, I'm going to use 5%. That is the weighted average cost of capital in the market. Then when I want also to compute the expected rate of return, I will also use that 5%, note number 1. But in some cases, you will find that examiner has given you expected rate of return like 5%. Then also examiner has given you Examiner has also given you the discount rate on during the year. Discount rate during the year. If examiner has given you that, then it means that I see you want to see me. Therefore, I will do like this so that you see me, so that you understand what I'm saying. So what I'm saying here is that sometimes examiner will give you the expected rate of return on planned assets, maybe 5%. Then discount rate during the year may be 6%. Therefore, expected return will be calculated on planned asset. And the planned asset you calculate is the opening planned assets, because that is what we have for investment, opening planned assets. And this one, we are going to calculate based on planned liabilities, opening planned liabilities. The discount, it goes the, but if the examiner gives you the corporate bond in the market, if the examiner is going to give you the corporate, just the weighted average, like in this question, interest gross yield on corporate bond, then that is what we use on both. Therefore, let's see what we are going to do here. Examiner told us that we do the required notes, but the required notes is what we are going to do as the steps to be followed. Therefore, in this question of May 2019, sorry, question number 3A. We are going to begin with the actual gain or loss on planned assets, planned liabilities. Let's begin with planned liabilities. Actual gain or loss on planned liabilities. We are in which year? Year 2019. 2018. Our year is 2018. We start with the present value of planned obligation. Planned obligation at the beginning, examiner gave us 3080. 3080, that is the opening obligation. Then we check if we have current service cost. Current service cost will increase. Current service cost 209. Then we have in note number 2, examiner is saying on 1st January 2018, the pension plan was amended to provide enhanced benefit with effect from that date. The present value of the enhanced benefits as at 1st January 2018 was calculated by actuary as 110. Therefore, that qualifies to be past service cost. Past service cost 110. Past service cost 110. Then we have interest expense. Now, interest expense we compute based on the opening balance. Therefore, I'm going to take 3080. Then I'm going to add something, then I explain. Here, remember this past service cost. When we are calculating this interest, you calculate based on the opening balance. Listen very carefully here so that you understand what I'm saying. You calculate based on the opening balance, because when the actuary comes, actuary will always come at the beginning of the year. And at the beginning of the year, that is when we are evaluating what would be the scheme cost, or what will be the total assets. Therefore, when the actuary comes, already we have amended the scheme, we have 110. Therefore, 110 arose on 1st January. 110 arose on 1st January. Therefore, it will also be part of the liabilities that are available at that time. Therefore, we add, then we take 5% of each. Why am I adding? Because the examiner told us that this enhanced benefits arose on 1st January, or that date, 1st January. Therefore, it means it's going to be part of, but if it arose during the year, listen very carefully. If it arose during the year, then you don't add. If it is during the year, you don't add. But if it is at the beginning of the year, we are adding because it's part of the liability there. Therefore, you give me 5% of that quickly. Kindly learn how to give answers quickly. 159, thank you, Ruth. We take it to 160. Let's round off to 160. I believe you have understood what I have done there. Then we come to less benefits paid. We come to less benefits paid. Our benefits paid is 242. 242. Then we get what we call projected. We get projected book value there. Then we compare with our present value of plan obligation at the end. At the end, which examiner has given us that 360. Then the difference will be what we call actuarial. You say that is it, which one is 43 kindly? You come clear, Ruth. Is it total or the difference? Difference, you say 43. Thank you very much. Loss or gain? Is it a loss or gain? Because we need to compare with the projected loss. As you say, it's a loss. Thank you very much. It's a loss. Then we go to actuarial gain or loss on plan assets. On plan assets there. Here, we are in year 2018. I'm going to take fair value. Fair value of plan assets at the beginning, which is 2860. 2860. 2860. Then I come to add the contributions during the year. Contributions during the year, we have 259. Then I come to the expected return. Which is 2860 times 5%. 2860 times 25%. 2860 times I'm getting 143. Then I come to less benefits paid. We less benefits paid. Benefits paid is 242. Then we get the projected. Projected book value. $30.20. You will confirm. $30.20. You will confirm. Then I compare with the fair value of plan assets. At the end, thank you very much, Ruth. Thank you very much. That 113. At the end, we have that 113. Therefore, the difference is what we call the measurement loss or gain, actual gain. The difference, we call it a gain of 93. Thank you very much. We have the gain of 93. Thank you very much, Ruth, for supporting Marimu. That is step number one, actual gain or loss on plan assets or plan obligation. Then we go to prepare the statement of comprehensive income. Statement of comprehensive income. Statement of comprehensive income. Statement of comprehensive income. We prepare statement of comprehensive income. We are still in the year 2018, don't forget. Here we are going to take actuarial gain on plan assets, which is 93. Then we less actuarial loss on plan liabilities, which is 43. Then we get OCI. What goes to OCI is 50. What goes to OCI is 50. And remember, if it is all gain, you add. If it is all loss, you add. Kindly, just in accounting, you just use the accounting knowledge that suppose it was all gain. For example, gain, gain. Then you add all of them together. Suppose it was all loss. Then you add, that is a net effect, actuarial loss or actuarial gain. But here, I'm subtracting because it's a gain and a loss. But if it, suppose it's all losses, here is a loss, here is a loss. You add, you get a bigger loss. If it's a gain, here gain, you add, you get bigger gain. Therefore, what I'm saying is that you need to report one item. You need to report one item because I know very much many students confused because they did not do anything that has either gain. Now, when he gets that, he gets confused. No, it is just accounting knowledge that, for example, if it is gain, you add, you get bigger gain. If it is loss, you add, you get bigger loss. If it is gain, loss, you subtract, you get. Or if the loss is more, you take the loss minus the gain, you still get a loss. That is just accounting knowledge, nothing new there. Then let's go to income statement. Income statement or profit or loss statement. Profit or a loss. Profit or loss statement there. Profit or loss statement there. We are still in year 2018, sorry. Current service cost is 209. Past service cost is 110. Interest expense is 160. Less expected return on plan asset 143. Then we get pension Pension expense there. You get pension expense there. You get pension expense there. What will go to profit or loss as pension cost? Pension cost. Then we go to balance sheet. We go to balance sheet. We are still in year 2018. I will take present value of plan liabilities at the end. Present value of plan liabilities at the end, which is 3360. Then I less fair value of plan assets at the end. At the end, then I get plan liability or pension liability. Somebody asked yesterday, is it plan liability or pension liability? It means the same thing. Because we are reporting on the scheme, it is either pension liability or plan or scheme liability or scheme assets or scheme obligation. It means the same thing. Therefore, that is what the examiner wanted to give you 8 marks there. 8 marks there. That's what the examiner wanted. I just want us to look at one last question before we wind up this topic. I want us to look at one last question, because I know you need to deeply understand this concept. Examiner will be testing you in one way or another. Therefore, you need to deeply understand this. Therefore, let's look at one last question. That is April 2022. April 2022. April 2022. One last question. April 2022. April 2022. April 2022. April 2022, question number 3B. Question number 3B, April 2022, question number 3B. April 2022, question number 3B says, the following accounting information was extracted from the financial records of Kibo Limited regarding the defined retirement benefit scheme for the employees. We have net defined obligation as at 1st January 2021, 1850. Net defined benefit obligation as at that 1st December 2021, 2000. Current service cost, contribution to the scheme, benefits paid. The market yield on high quality corporate bonds is at the rate of 5%. Assume there are no tax implications regarding retirement benefits scheme obligation required. With suitable calculation, explain the accounting treatment of various elements on the defined benefit scheme on the financial statement of Kibo Limited for the year ended at 1st December 2021 in accordance with International Accounting Standard. Now, with suitable calculation, explain the accounting treatment. Accounting treatment means how are you going to account for For example, current service cost, contributions. How are we going to account for it? That is what examiner wanted. How are you going to account for current service cost? Now, accounting treatment, we can say current service cost, past service cost, and interest cost are charged directly to P&L as expense. Or if you so wish, you can keep a journal entry. Journal entry means current service cost. You are going to debit P&L, you credit PPO. That is what we are saying. Current service cost, past service cost, and interest costs are charged directly to P&L. Then number 2, contributions to the scheme. Contributions to the scheme are not charged to P&L, but will be part of the scheme assets. Scheme assets will be part of the scheme assets. Those are what the examiner wanted you to do. That is what the examiner wanted you to do. Contributions are not part of the expenses under BP scheme, but you are going to charge it to the assets. Therefore, they are part of the scheme assets. Therefore, you need to debit plan asset. You credit cash. That is what the examiner wanted you to do, to explain the treatment of various items. You are just going to explain the treatment of various what? Various items there. Treatment of various items there. That is what the examiner wanted. Very straight, very clear there. Then we have not finished. Then after that, now we come and account for this scheme. We come to account for this scheme. Therefore, it means that now this examiner wants somebody who has understood the concept. You don't just come to class to cram what we do. You are going to deeply understand the concept, because in this one, if you have not understood the accounting treatment of these items, you will not be able to understand what the examiner wants, because he said explain the accounting treatment of various items. Therefore, here you are going to explain to the examiner that if I have the current service cost, where do I take it? I take it to P&L. If I have the contributions, where do I take it? I take it to plan assets as the employer. Therefore, examiner wants somebody who has understood the concept. That's why I encourage you, many students, that you need to be consistent in class and also do a lot of research to deeply understand the concept so that you account properly. Now, let's go to the part of accounting. When you check in this question, examiner has not given us plan assets. Listen very carefully. Examiner has not given us plan assets, only plan obligation. But this plan obligation is telling us that it is net defined benefit obligation, net. Therefore, if it is net, it means, what we mean by net? It means we have already subtracted the plan assets. Examiner is giving us net. Therefore, it means we have already subtracted the assets. Now, let me show you what you are to do here. We are going to say actual gain or loss on plan obligation. Actual gain or loss on plan obligation. Now, here we begin with net defined Net defined benefit obligation. At start, we were given 1850. At start, 1850. Then we come to add current service cost. Current service cost, which is 200. Then we come to add interest cost. We come to add interest cost. Interest cost will be 1850 times 5%. The corporate bond in the market is 5%. The corporate bond in the market is 5%. Therefore, we take interest cost 1850 times 5%. How much? 92.5. Thank you very much, my good friend Ruth. 92.5. You are supporting Malik very much. Then we come to less contributions. Remember here, we don't have the assets. Therefore, the contributions will be adjusted in the obligation. It is going to reduce the obligation, that contribution, because we don't have the assets. The contributions is coming to reduce. Contribution is 225. 225. I less 225 there, contributions. And in this case, if examiner has given me net, it means that I'm not going to adjust there the benefits paid. Listen, I'm not going to adjust there the benefits paid. Why? Because benefits paid, my good friends, is a contra entry. It affects the asset, it affects the liabilities. But remember here, examiner has given me net, which means this benefits paid will not affect only the liabilities. Therefore, that is what we do. Then we give me the projected. You give me the projected book value, projected book value. We are not going to include there the benefits because that is a contra entry. If examiner gives you net, then you avoid the benefits paid because it's a contra entry. It's a contra, both assets and liabilities. What will be the net projected book value? Then we come to net. We come to net defined benefits obligation at the end, which is 2000. 2142.5. Then the difference, you can call it the measurement. It is the measurement loss or actuarial gain or loss. Actuarial loss. You can call it the measurement or actuarial loss, it's acceptable. 1917. You say 1917.5, Edwin, thank you. 1917.5. Then you give me the measurement loss there. Then we go to pension expense. We go to pension expense there. We go to pension expense where we are going to take current service cost. Current service cost, which is 2,200. Then interest costs. Interest cost is 92.5. 92.5. Nothing else. Therefore, this is the one that is going to P&L. P&L. Then the Balance sheet, we are just going to take the 2,000. This 2,000 will go to the balance sheet because it's the net they have already adjusted the balance sheet. We are just going to take the net defined benefit obligation because it's already net. We are not calculating anything, it's already net. There we just take it there. But in the P&L, I'm taking current service cost and the interest cost there, which is, I believe, 292.5. That is what you are required to do in that question so that you get your 8 marks for free. So that you get your 8 marks for free. Now, for us to finish this course completely, for us to finish it completely, let me give you 82.5. Thank you very much. You say 82.5. Now, I want to give you the last class statement. This statement concerns BC scheme. I'm going to give you the last statement, and this statement concerns the BC, defined contribution scheme, because remember, this scheme needs to present the statement each year. Therefore, how do they present their statement? This is scheme. Therefore, let me give you the last statement as we complete this topic. As we complete this topic, let me give you the last. Let me give you the last statement. Or before I give you the statement, it's prudent that we have a break of 5 minutes. Let's just have a break of 5 minutes, then we come back. Just 5 minutes kindly. Okay, I want to give you the statement of changes in net assets as per we say statement of changes in net assets available for benefits in accordance with IAS 26. Statement of changes in net assets available for benefits in accordance with IAS 26. This is a very straightforward statement. There is no need of going into detail. It's a very straight. Therefore, let me assume we are in year 2020. Therefore, here you take a fair value of plan assets at start. Fair value of plan assets at the beginning of the year. You take fair value. I believe when I say fair value, you understand because you have been dealing with the fair value of plan assets. Then, what will increase the plan assets? We come to add expected return. Expected return. Or we say investment income. Investment income from plan asset, investment income from plan asset. We have dividend from plan asset. And we have maybe rental income, for example, rental income from plan asset. Rental income. Maybe we have other incomes from plan, other incomes. Then we come and less benefits paid. You come and less benefits paid there. You come and less foreign taxes. Foreign taxes, foreign exchange losses, foreign exchange losses, foreign exchange losses, you come and subtract their foreign exchange losses. You come and also less a loss on disposal of investment. Loss on disposal of investment, you come and less loss on disposal of investment. Then you also come and less transfer to other schemes. Transfer to other schemes. Transfer to other schemes. Yesterday, our good friend, I think Waziri was saying that sometimes you move from county government to national government. Therefore, when you move from county government to national government or national government to county government, your benefits will be transferred to that scheme. Therefore, that transfer will reduce the net assets there. Then we also come and less management expenses, management expenses. Then we less administrative expense. Then we get our total there. Then we compare with plan assets at the end. Land assets at the end, you compare with land assets at the end. The difference is remeasurement. Remeasurement value, it can be either a loss or again remeasurement value there, remeasurement value. Therefore, that is a very straight statement of changes in net assets available for benefits in accordance with IAS 26. And that marks the end of our topic, employee benefits. That marks the end of our topic, employee benefits. That marks the end of our topic, employee benefits. This is the measurement value. Remeasurement value. Remeasurement value. Remeasurement value. Remeasurement value. Remeasurement value. Now we straight go to another topic. Remember, time is not on our side. Therefore, any given minute, we utilize it very well. Therefore, we move on to another topic. And that is income taxes. We go to another topic, which is income taxes. Income taxes. We go to another topic, which is income taxes. The heading is a statement of changes in net assets available for benefits in accordance with IAS 26. Statement of changes in net assets available for benefits in accordance with IAS 26. IAS 26 in accordance with IAS 26. Income taxes, IAS 12. IAS 12, income taxes. Now, when we talk of income taxes, these are taxes that a company needs to pay to tax authorities. Remember, every company will be required to pay tax. Like in this regime, our government currently is looking for tax right, left, and center. Everything you are required to pay tax. You are required to pay tax. Even anything you get in terms of return, you are required to pay tax. Therefore, this government is taxing people very much. Although it's good to pay tax, it's good to pay tax because you build your own nation. But remember, what I'm bringing up is that every company, every individual, you are required to pay tax. Therefore, under income taxes IS 12, there are two types of taxes. There are two types of taxes. Number one is current tax. Number two is deferred tax. Number one is current tax. Number two is deferred tax. Current tax and deferred tax. Now, when we talk of current tax, this is tax payable, current tax. This is tax payable. This is tax payable to tax authorities, each year. Each year, we call it corporation tax. We call it corporation tax. Tax that the company will pay each year from its accounting profit. From your accounting profit, you are required to pay tax. When we talk of deferred tax, these are tax payable in future. You have it today as tax, but you don't submit to tax authorities until future periods, which means you defer, you pay it in future. Or we can say, these are tax consequences on assets and liabilities. Tax consequences on assets and liabilities. Tax consequences on assets and liabilities. Now, before we go in deeper to deferred tax, let me introduce current tax. Let me introduce current tax. Now, I have just said that current tax is tax payable during the year from your normal business operations. When you operate a business, you get profit, you are required to pay tax. Now, under current tax, we are required to look at some items. Number one is over and under provision of tax. Provision of tax. Number two item is recognition of unpaid tax. Unpaid tax. If you have not paid tax, how do you report it in your financial statement? Now, for me to discuss over and under provision, let me show you something. When we go to discuss over or under provision of this, let me show you something. Let me show you something here, which is very good. How do you pay tax? Remember, as a company, you have what we call accounting profit. Accounting profit. How do you prepare accounting profit? Listen, because this introduction will be very important to you. We have sales, you less cost of sales. We get what we call GP. GP is the gross profit. Then I come to less expenses. Expenses will be like salaries, rent, depreciation, donations. Then I get profit before tax. Then I come to tax this, I come to less taxation. I come to less taxation, then I get profit after tax there. I get profit after tax. If you are following up very keenly. Now, this tax, let me say it's 200 million. That is what you present to tax authorities. But when you take it to tax authorities, they will not agree with it. Why? Because in accounting, we use different principles with taxation. Therefore, this tax will not be acceptable. What the taxman will do, he will take now a taxable profit. Let's say taxable profit. Now, after the taxman has disagreed with this tax, what he will do, he will take your profit before tax. Profit before tax. Because he has rejected the tax of 200, you take the profit before tax, then it becomes an add back. Non-allowables. There are some expenses that the tax authorities will not allow you as an allowable expense. Example is depreciation. He adds back because it's not agreed. Donations. He adds back. General provisions. General provisions. He adds back. Then whatever he gets, he comes and less allowables omitted. Allowables omitted. What are the allowables omitted? Now, for you as an accountant, you don't recognize what we call capital allowances. You don't know capital allowances. That one is only found to tax authorities. Therefore, you did not subtract from your statement, but the taxman will recognize it. Therefore, the taxman will get what we call taxable profit. Taxable profit. Now, this taxable profit is where the taxman is going to eat his share. Taxable profit. For you as an accountant, you prepared the accounting profit. This is the profit you are presenting to your shareholders. You are presenting to your shareholders 200. Then this tax, you are providing for it. You are providing for this tax. Now let me say, you provided for 200. When the taxman comes to the calculate, he gets 150. This is the exact tax you are required to pay, 150. Exact tax you are required to pay is 150. Therefore, in this case, we are going to say that you over-provided for tax. Are you getting Marimu there? You over-provided for tax. Why? Because for you provided 200. Remember, tax is paid in arrears. Don't forget this important concept. Tax is paid in arrears. That's why we are talking about over and under provision. Now, for you are going to provide 200, but when we come to the exact tax, it is coming to 150. Therefore, here you over-provided. Over-provided. Now, if you over-provided tax this year, let me say it's year 2024. You over-provided because you over-provided for 200, but the exact tax is 150. When we come to year 2025, maybe your tax is 300. This tax is 300. And in the previous year, you over-provided with 50. Therefore, how much am I going to present? 300 minus over-provision. Over-provision of 50. Therefore, I'm presenting 250. I less the over-provision of the previous year. But if it was under provision, then it is the reverse, which is true. If it was under provision, then I underprovided, for example, here, it was 200, Then here, I'm required to pay 250. I'm required to pay 250 out of the 200. Then I under provided for tax. When I come to this here, my tax is 300. Then I add 50. Therefore, my tax comes to 350. My tax comes to 350. You adjust the under provision of the previous year. But if it was over provision, you subtract. Under provision, you add. Therefore, this is what happens when you are paying tax, corporation tax of the year. Now, let me again come here. When you see here, we have accounting profit, which you present to that to shareholders, and also there is taxable profit. For example, this tax, before even I go there, we go to unpaid tax, unpaid tax. Now, in my financial statement, I have provided for 300 tax. My estimated tax is 300. But remember, in my financial statement, in my bank, I only paid 100. I had tax of 300, but I only paid 100, which means 200 is unpaid. On my financial statement, on my P&L statement, I will take 300. 300 tax for the year goes to P&L. But remember, what I paid in the bank is not only what 100. Therefore, it means that the balance of 200, I will report it as a liability. I will report it as a liability in the balance sheet. You report it as a liability in the balance sheet. And paid tax is always reported as a liability in the balance sheet. And paid tax is always reported as a liability in the balance sheet. I believe you are understanding this because we shall be doing some questions. Then you ask, why are you reporting that and in the trial balance is this? I will just be reminding you, go to that video and check what we discussed. And paid tax, we report it as a liability. But tax for the year, total tax for the year, it goes to P&L as expense. Now, this profit of accounting profit and taxable profit will never be the same. In any case, it will never be the same. Why? Why will it not be the same in any case? There are two things that will make this profit never to be the same. Number one item, we call it permanent. Permanent difference. Number one item, we call it permanent difference. What is a permanent difference? Remember, when I'm preparing my accounting profit, there are some things I will include, like, for example, expenses like depreciation, donations, general provision, I will include as expenses when I'm preparing accounting profit. But when I go to taxation, these items will be added back, will be rejected and added back. Which means, if in accounting you don't subtract them as an accountant, then the auditor will qualify your financial statement. He will say, your financial statement does not show true and fair view of the financial status of the company. It does not show true and fair view of the financial status of the company. Why? Because you have left out some expenses. This one. But when it comes to tax authorities, he will always reject them. Therefore, we call them permanent differences. Now, what is a permanent difference? These are those items, listen, these are those items reflected in the P&L for a profit and loss statement, but they are disallowable for taxation. These are those items reflected in P&L as expenses, but they are disallowed for tax purpose. Permanent. It's very permanent. When you come to IAS 12, you must subtract depreciation. When you go here, Depreciation, they don't know it. What they know is capital allowance on assets. Number 2 item, we call it timing. Timing difference. What is a timing difference? Now, let me explain in the perspective. Timing difference means for accounting purpose, we use what we call accrual concept of accounting, accrual. When we go to taxation, on another hand, we use what we call cash basis of accounting. Therefore, when I'm preparing my accounting profit, I will include revenues even if I have not received the money. Once I earn my revenue, like today in NTC, I'm earning my revenue today. Therefore, in my financial statement, I will include the revenue earned. But are they paying me today? They are not paying me today. They will pay me maybe next week. Therefore, in my accounting, I included as revenue. But I'm not paying tax today because I have not received the cash. Therefore, that's what we call timing difference. Accounting uses what we call accrual concept. Taxation uses what we call cash accounting. Then what is timing difference? These are those items reflected for accounting purpose in a period different from the period it will be reflected for tax purpose. These are those items reflected in accounting profit in a period different from the period it will be reflected for tax purpose. So, like for example, I have given you the example of revenue. When the moment I earn revenue, I report it here, revenue for the year. But when I come to tax, they will ask me, did you receive this revenue? No, then they remove that revenue for tax. I will not pay tax on that. Therefore, we have what we call timing differences. Timing differences. Therefore, for timing difference will give us what we call deferred tax. We shall compute deferred tax based on timing difference. How do we compute deferred tax? Like, for example, I have earned revenue of 300. Listen very carefully. I have earned revenue of 300, but I only received 100. Therefore, during the year, for me, I will calculate 30% of this. It is how much? 90. But when we come to tax, I'm going to pay 30% of this, which is 30. Therefore, it means for accounting purpose, I reported this revenue, but I did not pay it. I did not pay this revenue. Therefore, the difference of 60, I'm deferring it to the future periods. Therefore, we compute deferred tax based on timing differences. Based on timing differences. I earned revenue of 300, tax was 90. But will I pay that 90? No. I will only pay 30 because cash, I received 100. Therefore, remember this one, 60, I have it as tax for accounting purpose. But for tax purpose, I'm not paying. Therefore, I defer it to the future periods. Now, that is, we have been explaining what is current tax. We have been explaining what we mean by current tax. Current tax. Now, examiner will not ask you much about current tax. Maybe the thing you need to know the over and under provision, because in published questions or in group accounts or in whichever questions, you will find them there. Therefore, you just need to understand the over provision, under provision, recognition of unpaid tax. You are required just to know it because of the publication purpose. Examiner will give you the financial statement to prepare, but in a footnote, there is something about tax, maybe over provision or under provision explained there. Therefore, you have to adjust so that you recognize. You need to understand very well there. That's why I'm taking my time here to explain. But When we go to deferred tax, I say this is tax consequences on assets and liabilities. And because it's a very wide concept that we need to discuss, I'm not starting it right away. What I just wanted you to understand so that we don't waste time is the current tax, how we do over and under provision. But in our next class, we are going to move on deferred tax, where the elephant in the house is on deferred tax. And this is where the KASNEB will bring a lot of direct questions. Here, it can just come as a footnote in the current tax footnote. But here, it is the elephant in the room. Therefore, I don't want to introduce it now. I just wanted to introduce it in our next class, probably on Monday, so that we move from there. Therefore, for today, I beg to stop there so that you internalize this concept. What we have done today, you internalize it as we wait for Monday. We begin on deferred tax. Thank you for your time. Bye-bye.